They say that during a gold rush, the best way to get rich isn't digging for gold, it's selling the picks and shovels. Well, right now we're in the middle of the great AI gold rush, and there's a company you probably haven't heard of that's selling the essential digital shovels, and Wall Street has definitely noticed. That company is Ciena, and today we're going to unpack how they became the center of a $60 billion AI dilemma.
Okay, just look at this number. In only 6 months, Ciena's stock went completely nuclear, exploding by 270%. I mean, you just don't see a surge like this for a company that makes, physical hardware. It catapulted them into the same league as the hottest AI software companies out there and turned them into a $60 billion superstar.
So this brings us to the big question, right? How in the world did a company that literally lays the physical groundwork for the internet become one of the most talked about and, frankly, most expensive stocks in this whole AI revolution? Let's dig in.
So how did they do it? To really get Ciena's insane rise, you first have to understand this fundamental shift they made in their business. They went from being just another supplier to being absolutely mission-critical for the entire AI economy.
Okay, so at the heart of all this is a concept called Data Center Interconnect, or DCI. Think of it like this. These huge AI models, they're too big to live in just one building. They're spread out across multiple, massive data centers that all need to talk to each other, like instantly. And we're talking at the speed of light. Ciena? Well, they're the ones building the digital superhighways that make it all possible.
Now, this is where it gets really, really smart. Just look at this. It shows a genius-level strategic pivot. Ciena used to rely on old, slow-moving phone companies for their business, but now a whopping 42% of their revenue comes directly from the cash-rich cloud giants. We're talking Meta, Amazon, a segment that grew an insane 76% in just 1 year. They literally just followed the money straight into the heart of the AI boom.
In that pivot, it has built an incredibly powerful bull case for this company. The arguments for why Ciena is basically on an unstoppable roll right now are super compelling, and it all starts with one thing. They have something close to a monopoly on some seriously critical tech. So, the key here is what investors call a technological moat. Basically, a competitive advantage that's almost impossible for anyone else to get over. Their WaveLogic 6 engine is the first in the entire industry to hit 1.6 terabits per second. Now, this isn't just about being faster, it literally doubles the capacity of the fiber optic cables that are already in the ground. And this is huge for power-hungry AI. It cuts energy use in half. Plus, by buying this company called Nubis, they're now moving inside the data center itself, opening up a whole new market. This tech advantage has led to something absolutely massive, an order backlog of $7.8 billion. To put that into perspective for you, that is more than their entire revenue from last year, and it's already locked in. This number is just incredible because it means their revenue for the whole year is pretty much guaranteed. It basically de-risks their entire business for the near future.
And this, right here, perfectly illustrates their new spot in the market. They're not just selling boxes anymore. They have effectively become an AI toll booth. As this tidal wave of AI data just keeps getting bigger and bigger, Ciena is sitting there, ready to collect a fee on almost all of it. It's an amazing story, right? But it's only half the story. Now we have to look at the other side of this $60 billion coin.
Because, for every amazing bull case, there's always a bear case waiting around the corner. And for Ciena, the argument isn't about whether it's a good company. It's about the absolutely terrifying price of its stock.
Just take a look at these valuation numbers. Ciena is trading at a forward price-to-earnings multiple of over 64. Its peers, big established companies like Cisco, are at less than 17. And what's even crazier is the EV to EBITDA ratio. It's a key profitability metric. It's getting close to 100 times, compared to just 14 for Cisco. What this all means is that investors are paying a massive, massive premium, assuming absolutely everything will go perfectly. If they have even one little stumble, the stock could just fall off a cliff.
One analyst in the research we looked at put it really bluntly. They said the margin of safety at these multiples is functionally zero. That means if the company has even one tiny misstep, just one slightly disappointing quarter, the stock has a long, long way to fall. There's no cushion.
And maybe the single biggest red flag of them all is this number: negative $64 million. That's the net amount of stock sold by company insiders over the last year. Which leads to a pretty obvious question. If the future is so bright, who exactly is selling?
Well, it's the people who know the company best. The CEO, Gary Smith, he sold over $1 million worth.
The head of global sales, Jason Phipps, cashed out over $9 million. And all of this is happening while there have been exactly 0 insider purchases. When the people who are supposed to know the most are all heading for the exits, that's a signal you just can't ignore.
And finally, that whole monopoly idea? Well, it might just be an illusion. After a huge merger with its rival Infinera, Nokia now actually controls a slightly bigger piece of the global market. For the first time in years, Ciena is facing a true competitor on its own level, one that could absolutely start a price war to win back customers. This new competition is a direct threat to those high profit margins that everyone loves.
So, where does that leave us? On one hand, you've got this spectacular, tech-dominant company. And on the other, you've got this dangerously expensive, high-risk stock. It's time to put these two stories together.
And here's the whole dilemma on one slide. The bulls see a tech monopoly, a huge backlog, incredible growth. The bears see a crazy valuation, insider selling, and a powerful new competitor breathing down their neck. And the thing is, both sides are making really good points.
And that brings us to the final verdict from the source material, which is a hold. Now, this isn't a call to sell, because the company itself is phenomenal, but it's a huge warning sign that the stock price has just been driven up by pure euphoria, and it's simply not a smart place to be putting new money to work right now.
Look, there's no doubt Ciena is a revolutionary company. They are literally paving the digital roads for the entire AI era. But it all forces us to ask this really fundamental question. In the absolute frenzy of a gold rush, is there a price for even the best picks and shovels that's just too high to pay?